Okay, so in this lecture, we're going to study Chapter 13, Return, Risk, and Security Market Line. So risk and return. This risk-return trade-off should already be a very familiar concept because many decisions in life involve risk. And we consider the trade-off between risk and return when we make decisions. For instance, as a student, you may often have a hard time deciding whether or not you should go to class today. So what's the reward for skipping a class? Where you can have more fun elsewhere. How about the risk? Where you may miss something that could be on the exam. So that's the risk and return trade-off that you make when you decide to skip a class. The trade-off between risk and return in financial markets can be summarized by the security market line. So we got risk on the x-axis, and reward risk premium, which is a reward for taking risk. Or reward on the x-axis, the y-axis, then we're going to learn that there's a linear relationship between risk and risk premium. Basically, the higher the risk, the higher the risk premium should be. Otherwise, why would anyone take risk? So in this class, we're going to formalize this risk-return trade-off. So let's look at some specific example to understand the risk-return trade-off in financial markets. We're going to focus on the stock market, but the general principles that we learned from the stock market will carry over to other financial markets as well. Here we have two companies, Tiffany and Procter & Gamble. Tiffany sells jewelries such as diamond rings, whereas Procter & Gamble sells toilet paper, toothpaste, and many other things. The first question that we'd like to answer is, which stocks do you believe have more risk? The second question, which is a related question that we'd like to answer, is on average, at least on average, which stock would you expect to earn higher return? So if you invested $100 in Tiffany at the end of 2004, your investment would have grown to $546 at the end of 2019. The same figure for Procter & Gamble is only $348.87 at the end of 2019. So Tiffany, as you can see here, at least on average earns higher returns than Procter & Gamble. But also, as you can see here, there have been many large drawdowns in Tiffany stock prices. So Tiffany seems to have more risk as well. You can see this more clearly in the next figure. Tiffany has more big ups and downs compared to Procter & Gamble. So Procter & Gamble stock prices kind of moves like this, whereas Tiffany stock prices kind of moves like this. So Tiffany has more risk. Specifically, Tiffany has more total risk, which measures volatility or variability of stock returns. We're going to quantify risk and return before we study the trade-off between risk and return. For this, we're going to borrow heavily from statistics. We're going to review statistics only very briefly here, so you may want to brush up on things that you have learned in your intro stat class on your own. First, expected return. So expected return is basically the average return. More specifically, the expected return is probability weighted average of returns in all states. States here mean possible scenarios that can happen in the future. The risk premium is defined as the expected return in excess of the risk-free rate. Risk premium measures how much more return you can expect to earn by taking risk over what you can earn without taking any risk. Next, variance and standard deviation. They measure the variability or volatility of returns, which is total risk. Variance is probability weighted average of squared deviations from expected return. Standard deviation is just the square root of variance. Because we take the square root here, which sort of cancels the square over here. So standard deviation has the same unit as the expected return. So let's look at an example to see how we can compute the expected return, risk premium, standard deviation, and variance. So there are two companies, ice cream company and umbrella company. And there are two states, so only one of the two things can happen in the future. It could be either sunny or rainy. If it's sunny, ice cream company would do so much better than umbrella company. But if it's rainy, the umbrella company would do so much better. So the expected return for the ice cream company is the probability of it's sunny times the return on the ice cream company if it's sunny plus probability of it being rainy times return on the ice cream company if it's rainy. So 0.8 times plus 0.2 times 0.10. So this is equal to 0.26 or 26%. So this is the expected return for ice cream company stock. How about the risk premium on the ice cream company is 26% minus the risk-free rate, which is given here as 10%. So the risk premium on the ice cream company is 0.16 or 16%. So that's the risk premium. How about standard deviation? Well, we have to first compute the variance. So the variance of the ice cream company, which we denote by sigma squared. So the probability of it being sunny, which is 0.80 times squared deviation from the expected return. So 0.30 minus 0.26 squared plus the probability of it's rainy, 0.20 times square deviation of returns from the expected return is 0.10 minus 0.26 squared. The variance is 0.0064. And the standard deviation is, which is denoted by sigma, is square root of the variance. So square root of 0.0064 is 0.08 or 8 cents. So it has the same unit as the expected return. Similarly, you can compute the expected return, risk premium, and the variance and standard deviation for the umbrella company. So the expected return of the umbrella company is negative 2%, and the risk premium on the umbrella company is negative 12%, and the variance of the umbrella company is 0.1296, and the standard deviation is 36%. Okay, so let's summarize things here. The umbrella company has a standard deviation of 36%, whereas the ice cream company has a standard deviation of 8%. So the umbrella company has more total risk than ice cream company. However, the umbrella company has a risk premium of negative 12%, whereas the ice cream company has a risk premium of 16%. So that's a little strange here because earlier I said the higher the risk, the higher the risk premium should be. But here, umbrella company has more total risk, but still has lower risk premium. So what's going on here? Actually, this example demonstrates that total risk is not an appropriate measure of risk when we think about the risk and return trade-off for individual assets. Even though umbrella company has more return volatility, if you look at its returns across states, we see that it kind of works like an insurance. Normally, it does poorly. You just keep paying insurance premium without receiving anything in return. But in bad times, it really pays off. So it hedges against risk. That's why risk-averse investors are willing to buy an insurance even if the expected return is negative. So on average, you lose money by buying insurance. But you still want to buy insurance because it protects you in bad times For instance, when your house burns down. But most financial assets are risky and have positive risk premium. And what's the appropriate measure of risk to define risk and return trade-off? To answer this question, we first have to understand portfolios. Portfolio is just a bunch of assets. And the expected return on a portfolio is simply the weighted average of the expected returns on individual assets. However, the variance of a portfolio or standard deviation much more complicated because of all the covariances and correlations. So let's look at an example. So this is the same example that we've seen before, but now we got $10,000 $10,000. We want to invest $5,000 on ice cream company and the rest on the umbrella company. So the weight here is 50-50. So this is our portfolio. So these portfolio returns, so here this case, sunny, if it's sunny, the probability is 80. So it's sunny with a probability of 80%. And the portfolio return is so the weighted average of individual asset returns. So 50% times 30% plus 50% times negative 20%. So this is 0.05 or 5%. That is if it's sunny. So if it's rainy, this probability of it's rainy is 20%, and the portfolio return is 50% times 10% plus 50% times 70%. So this is equal to 0.40 or 40%. This is 5% if it's sunny. So the expected returns on the portfolio is probability of is sunny times portfolio return if it's sunny plus probability of it's being rainy times portfolio return if it's rainy. So this is 0.80 times 0.05 plus 0.20 times 0.40. So this is equal to 0.12 or 12%. So this is the portfolio return, portfolio expected return. This is simply the weighted average. So this is equal to the weighted average of the expected returns on the individual asset. So this is 50% times 26% plus 50% times negative 0.2 or negative 2%. How about the variance and standard deviation? So the variance in the portfolio is probability of it being sunny times the scared deviation of returns from the expected return. So 5% minus 12% squared, 0.05 minus 0.12 squared. So this is 80% plus probability of it being rainy, which is 20% times the scared return deviation. So 40% minus 12%, 0.40 minus 0.12 squared. So the variance is 0.0196. So standard deviation on the portfolio is 14%. Okay. And this portfolio standard deviation is actually less than the weighted average of standard deviations on the individual assets, which is 0.5 times 0.08 plus 0.50 times 0.36, which is 22%. So the weighted average of standard deviations on the individual assets is 22%, but the portfolio standard deviation is much lower than the weighted average. So this is 14%. And this is one of the most important results in finance, which is often summarized by, don't put all your eggs in one basket. It's always better to diversify. Diversification can substantially reduce the variability of returns without the equivalent reduction in expected returns. The expected return is still just the weighted average of expected returns on the individual assets. However, the standard deviation of portfolio returns is almost always lower than the weighted average of standard deviations of individual asset returns. And this reduction in risk arises because worse than expected returns from one asset can be offset by better than expected returns from another. And this important result was first published by Harry Markowitz in the Journal of Finance in 1952. And for this, Harry Markowitz won the Nobel Prize in Economics later in 1990. So there are actually two types of risk: systematic risk and unsystematic risk. And by diversify, you can get rid of some part of total risk, as you can see in the figure below. So the part of risk that can be diversified away is called unsystematic risk, whereas the remaining part is called the systematic risk. And systematic risk includes risk factors that affect a large number of assets. And systematic risk is also called undiversifiable risk or market risk. On the other hand, unsystematic risk includes risk factors that affect only a small number of assets. So it's called unique risk and asset-specific risk. So by including more and more stocks in your portfolio, you can reduce total risk more and more, but only to a point. And there's a minimum level of risk that cannot be diversified away, no matter how many stocks you hold in your portfolio. And that's the systematic portion of total risk. And so this is theory, and a more practical question would be, how many stocks do you need to invest in to get rid of virtually all diversifiable risk? And studies have shown that to have a well-diversified portfolio, investors typically have to invest in at least 20 to 30 stocks across different sectors. And this is a very important recommendation for all investors. Because you can diversify away unsystematic risk, all that matters to investors should be the systematic risk. And this is called systematic risk principle. So there's a reward, at least on average, for bearing risk, but there is no risk for bearing risk unnecessarily, and only rewarded for bearing systematic risk. So the expected return on a risky asset depends only on the asset's systematic risk, because unsystematic risk can be diversified away. So the question is, how do we measure systematic risk? Again, we borrow from statistics. So we use the beta coefficient in a linear regression model to measure systematic risk. So specifically, we regress the individual asset returns on market returns. So something like this. And we use the S&P 500. Typically, we use S&P 500 for the market. We estimate the beta coefficient, which is the slope coefficient of the linear regression line that has the best fit to this linear pattern. The market has a beta of 1 by definition, and the risk-free asset, which has no risk, as the name implies, has a beta of 0. So it has 0 systematic risk. And portfolio betas is simply weighted averages of the betas on individual asset. So this is different from standard deviation of the portfolio. So let's look at the example. Here, I regress monthly returns on Tiffany on S&P 500 returns on the left panel, and I regress monthly returns on Procter & Gamble on S&P 500 returns on the right panel. So I want you to notice two things. Both Tiffany and Procter & Gamble has a positive beta. Because they are a risk asset, they must have positive betas. And second, the Tiffany has higher beta than Procter & Gamble. If you look at the slope coefficient here, Tiffany has a beta of 1.70, and Procter & Gamble has a beta of 0.46. So Tiffany has more systematic risk than the market. So this is greater than 1. So it's an aggressive stock. So in good times, Tiffany does really well. So when they have a lot of money on luxury items. But on the other hand, in bad times, Tiffany does really poorly. When people go out of jobs and housing prices collapse, people tend to cut down on their spending on diamond rings. So Tiffany does really poorly in bad times. So this is the risk that investors care about. Stocks with high beta can hurt investors exactly when it hurts the most. So investors demand higher compensation for bearing greater market risk. In contrast, Procter & Gamble has a beta that is much lower than the market. So it's a defensive stock. In good times, people buy toilet paper. In bad times, still buy toilet paper. So the stock price of Procter & Gamble is not very sensitive to market conditions. So Tiffany has more systematic risk than Procter & Gamble. This is why Tiffany has higher expected return than Procter & Gamble, not because Tiffany has higher total risk. So in general, the higher the systematic risk as measured by beta, the higher the risk premium should be. In fact, we can actually quantify the exact relationship between risk premium and beta. And this is a very important result. In equilibrium, all assets and portfolios must have the same reward to risk ratio. So we measure reward by the risk premium, which is the expected return minus risk-free rate, and we measure systematic risk by beta. So all assets have the same reward to risk ratio, and they all must equal the reward to risk ratio for the market. Let's look at an example to see how this works. So here we have asset A and asset B, and asset A has a beta of 1.6, and asset B has a beta of 1.2. And asset A has expected return of 20%, asset B has expected return of 16%. And the risk-free rate is 8%. So which investor is better? Which investment is better? I'm going to claim that asset A is better than asset B. So to see this, let's consider a portfolio I'm going to call P that invests in asset A and a risk-free asset. And this portfolio has beta of 1.2. So we're going to construct a portfolio consisting of asset A and the risk-free asset, so that it has a beta of 1.2, which is equal to beta of asset B. And what is the expected return on this portfolio? We know that expected return on asset B is 16%. Let's compare portfolio P and asset B. So expected return on the portfolio is simply weighted average of expected returns on individual asset So weight on risk-free asset is just 1 minus weight on asset A. And also, the beta of portfolio is weighted average of beta on individual assets. So this is equal to 1.2. And the risk-free asset has a beta of 0. So if we solve this equation, then this gives us the weight on portfolio A, asset A, because the beta on asset A is 1.6. So the weight on asset A is 0.75. So this gives us the weight on the risk-free asset is 0.25. So portfolio P invests 75% of its value portfolio asset in asset A and 25% in risk-free asset. Then we can find the expected return on the portfolio. So expected return is just a weighted average of the expected returns on individual assets. So expected return on the asset A is 20%, and the risk-free rate is 0.08. So this is equal to 17%. So let's go up here. So as you can see here, the portfolio P has the same beta as the asset B, but portfolio P has higher expected return than asset B. So you rather invest in portfolio B, so hence you want to invest in asset A instead of asset B. So what will happen in equilibrium is that investors will buy asset A and sell asset B because asset A is more attractive than asset B. So this will push up the prices for asset A, which will lower expected returns on asset A because the price goes in the denominator for the expected returns. On the other hand, the price of asset B will go down because people try to sell asset B. So this will raise expected return. So the prices and returns for all assets in the market will change or adjust until all assets have the same reward to risk ratio. And this is true for all individual assets or at all portfolios, including the market portfolio. So the reward to risk ratio for individual asset is equal to reward to risk ratio for the market portfolio. And market portfolio has beta of 1. So if you cross multiply, then you get the risk premium on individual asset is equal to beta times the market risk premium. If you rearrange this, then the expected return for individual asset is risk-free rate plus beta times market risk premium. So this is also one of the most important results in finance. This is called this equation is called capital asset pricing model, or CAPM. And the visual representation of the CAPM is, so we got the risk on the x-axis as measured by beta, expected return on the y-axis. The risk-free asset has a beta of 0, so risk-free rate is here, and the market is here, and all individual assets will lie along this line. So this is called security market line, or SML. So to summarize, the capital asset pricing model defines the relationship between risk and returns in this way. And the CAPM shows that the expected return for individual asset depends on 3 things: the pure time value of money as measured by risk-free rate, and the reward for bearing systematic risk as measured by the market risk premium, and the amount of systematic risk as measured by beta. And this important result was published by P. Sharp in the Journal of Finance in 1964. And for this, P. Sharp won the Nobel Prize in Economics in 1990, along with Harry Markowitz. And this is all I want to talk about in this lecture. Thank you for watching. I will see you next class.